right. Good morning, everyone, and thank you for joining us for another Market Street Live event. This time we're doing an educational webinar, and so excited to have everyone join us. Today we're going to talk about equity compensation. It's something that we've seen be a shift in compensation from a lot of different companies, adding to just your normal set of salary, bonus, health insurance, whatever other employee benefits. This is just a different type of benefit that's gonna happen, and a lot more companies are offering these. So we wanted to do kind of an educational series, if you will, where we'll take some time, and Austin and I are going to unpack the different nuances that come into play when it comes to those. So we'll start diving in. If you have questions, throw them into the chat. We'll keep an eye on the Q&A feature and be able to kind of cover those as we go through, knowing this is a bit more of, I would say, a meatier topic than sometimes some of the market commentary that we often will go through. As always, quick disclosure, nothing that we're saying today is designed to be considered investment advice. This is something that we are just presenting from an educational perspective for our clients, and hope that you find some value out of it. And if you have particular questions about how anything we cover today might apply to your situation, reach out to your Market Street advisor. And with that being said, we'll keep moving right along. So as you know, I'm Aaron Williams. I am a senior financial planner here at Market Street, and I'm joined by Austin Angel here as another senior financial planner and new partner here at the firm. So as of earlier this year, Austin joined us as a partner on the team. So we're thrilled to have you as a partner.
Thank you.
And excited to have you join for all these sessions and being a part of the team going forward all the way. All right. So what we will cover today is we're going to kind of give a quick snapshot of the overall series of everything that we're going to kind of cover. There's three different main components when it comes to equity compensation. And so what we're going to cover today is the most common and what we see nowadays.
Yeah.
It's through RSUs, PSUs, and then restricted stock awards. And those are, I would say, it's been a transition to where that has been a larger piece of compensation for many companies. Next month, we'll do an entire series on stock options. The math gets to be a little bit more challenging to kind of follow.
A little bit more complex.
We'll walk through those. It takes a little bit more time.
Yeah.
And so we'll do that next month, and then we'll wrap up with this idea of ESOPs, employee stock ownership programs, or purchase plans, where you have the ability to kind of buy shares yourself. You make this decision as opposed to it being a part of your compensation package.
Yeah.
And then we'll wrap that up at the very end of that seminar, kind of talk through retirement strategy. As you get closer to retirement, what does it look like to diversify out of some of those shares as this becomes a bigger component of your overall financial picture? So today we're going to focus on, as we mentioned, RSUs, which is restricted stock units, PSUs, which is performance stock units, and then restricted stock awards. The last one isn't quite as prevalent, so we'll spend a little bit of time on that. But we're going to kind of talk through what are the main components that happen when it comes to equity compensation. What are RSUs and PSUs? We'll do a deeper dive there. What's the tax implications? Because this is one area where we find a lot of gaps.
Yeah.
Is there's not the same withholding level. And so people can be kind of stuck with lower withholding amounts. And that can create a surprise tax bill, which is never anybody's preference themselves. And then we'll kind of wrap things up and talk about what next month we'll look at. So, as I mentioned, today is on what's called full value awards. It's something where when you receive these shares and they vest and are delivered to you, you receive the full value of the stock at that point in time. Versus next month, we'll talk through appreciation awards, where it's something where you have to pay a portion to kind of get the shares themselves. There is a cost component to you, and so you're not receiving the full value, and you're playing more off of the appreciation from now until then. Everybody benefits when there's appreciation, but these are a little bit more full value that's actually being received at that point. Okay, so walking through what some of these items are in RSUs, restricted stock, I'm going to kind of flip it over to you, Austin, and taking a look at what is equity compensation as a whole. We know most people have a form of a salary, a bonus.
Yeah.
What is the incentive, and why is kind of equity compensation become a larger portion of people's total comp packages?
Yeah. So I think to get started, just like we need to understand definitionally what is equity compensation? What are we even talking about?
Yeah.
So equity compensation is pay, right? Like you said, salary, bonus. It's pay delivered in shares of your employer's stock. So to simplify that, it's basically your company giving you value in the form of their stock rather than true dollars.
Okay. Yeah.
And you can get dollars out of it. It just depends on whether you want to hold or sell, right?
Yeah.
Sometimes this ownership is conditional, like you have to meet certain profit margins or earnings. Oftentimes, like you said earlier, it's more we see of just the RSUs where you have a vest date. As long as you work until that vest date, you get the full value.
That makes sense. Why do companies start to compensate people
Yeah.
this way? What's kind of the main reason for them going that direction?
Yeah, so we kind of put three motives on here. I think there might be a fourth, and I'll run it by you.
Yeah.
So the three motives, the first is retention, right? Oftentimes this pay has a vesting date, and all that means is you have to continue to work at the company until that date
Yeah.
for you to receive the value. So unlike a salary is guaranteed each and every year, right? As
Right.
long as you're
Right.
working there, you get your salary.
Exactly.
In this instance, a vesting might be, let's say, a 4 year cliff, meaning year one, you get nothing, year two, you get nothing, year three, you get nothing, year four, you get the whole entire
So
value.
I have this incentive to stay at the company for
Yeah.
4 more years before I'm going to receive a portion of
Yeah.
compensation.
In our industry, we kind of have this jargony joke. We call it the golden handcuff.
Yep.
It's a super nice benefit, can be pretty lucrative, but to get the entire value and to have it continue to grow and build on itself, you got to be at the company for a while.
Yep. Yeah, that makes sense. That makes sense. So retention's a huge component of it.
Yeah. The second one is just alignment of interests, right? As an employee, unless you have equity or ownership in a company, or maybe certain performance bonuses, your interest, your work might not be aligned with the goals of the company itself.
Yep.
And so offering this ownership in the company, you kind of have this feeling, this incentive of if I do better, if my employees who I manage do better, if my division does better, hopefully that makes the stock price go up. My awards go up. I get paid more money.
Yeah. So beyond trying to for a normal bonus, if everybody's pulling in the same
Yeah.
direction, hopefully the stock price moves up. And now that I have ownership shares, I get some value out of it too, beyond you as the employer also receiving value from the shares,
Yeah.
all shares going up.
And the third one on here is deferred cost to the company. All that really means is it's a little bit of financial gamemanship, a little bit of accounting gamemanship from the company side of based on the vesting and the way kind of shares versus cash work on the balance sheet, it can make the company look a little bit better over the long run versus having a much, much higher salary on the books, right?
Yep. Yep. That makes sense.
And I think the fourth one here, Aaron, that we might have missed, but I think it's worth mentioning is attraction, especially of these highly, you know, niched executive jobs like a chief operating officer, chief financial officer, someone that has been in their career a very long time that probably has a lot of offers out there.
Yep.
It's how can we go above and beyond and put together this really attractive package for them?
Yeah, I think you're right. I think that makes sense because it can definitely be attractive. And one thing, and we'll cover the tax
Yep.
component of this too, is if I'm, let's say, late in my career, but I've got a lot of talent, I might want most of my compensation tied to these equity deferrals because I could retire, have my salary go away, but if the vesting schedule allows it to vest
Mhm.
into retirement, now that's all going to hit in a year where I don't have my salary ballooning my income.
No ordinary income.
And
Yeah,
so from a tax perspective, it can be this kind of deferred comp, if you will. And
absolutely.
I think you're right. I think that's another good one to be able to add kind of enough. A fourth motive is, especially once you start looking into C-suite level or manager director level individuals, having equity compensation can be a decent additional attractive point.
Yep.
So we had kind of highlighted earlier that we'll talk through kind of stock options
Yeah.
themselves. There was this shift where we used to see a lot more individuals have stock options as a portion of their
Yeah.
comp packages, and now it's kind of shifted to all this RSUs and PSUs component. Unpack for me kind of what we've kind of seen as being the main directive. Is that still the case?
Yeah, so very much so there has been this massive shift of stock options. So, you know, again, NSOs, ISOs, this much more of a contract. Do I want to execute? Do I want to buy or
Yep.
do I not? Meaning I, as the employee receiving this, I have the option. I get to decide if I actually want to go forward with this or not. To now where what we're seeing is RSUs and PSUs. So the difference there is at vest, RSUs, PSUs are yours. When
Okay.
you reach
Okay.
that
Yep.
date, it's your money, it's your shares. You don't get to decide, do I want to buy? Do I not want to buy? Um, in the long run, personally, I think this is a better move. As we mentioned earlier, stock options can be pretty complicated. There's some massive tax consequences if you don't plan well.
Yep.
Um, Stock options as well, as I said, and you kind of mentioned, there's this appreciation in meaning if you have a strike price here and the stock isn't doing as well or is maybe even pulled back, your options might not even be worth anything.
It could be, yeah, it could be what we consider a worthless or an exercises with
Yeah,
no value, and then that award really didn't give you any
yeah.
compensation.
You see this comp package and you see this award and you're like, okay, I'm gonna make this much money in addition to my salary and bonus. This feels really good. This feels really nice.
Right, right.
Well, if the stock's not doing great, it's not worth anything. And it could
Yeah,
take several years for it to recover, for it to be at a point where you're like, okay, now I do want to move forward with this.
that makes sense.
So overall, I do think it's a good shift in the landscape of things. Aaron, do you kind of want to talk about just, more in detail of why this actually happened? We saw this shift.
Yeah, yeah. So it's a great question, and kind of highlighted, and we got linked below here, an equity awards kind of, or an equity compensation blog that exists, and they kind of highlighted what happened over the last 20 years of this shift in why public companies went away from stock options to more of these RSUs. One, to your point, is you would have situations where most of the time stock options get granted to somebody and they have a strike price that you
Mhm.
have to buy at that particular share. And it's typically, for ease of math, whatever the price is the day that
Yeah.
it's given to you. Well, if the price goes down, it could be worthless by the time that it actually gets to a point where
Mhm.
you have to exercise that. And so there was this almost phantom compensation that existed. So employees wanted something where it's no, I want actual compensation. And the way that RSUs work
Yep.
is once the vesting schedule hits and you actually receive the shares, it is true. All of the share price is yours at that point in time, and it is true dollars that you can have access to. But back in 2000 to 2004, kind of the early 2000s era, 100% of public companies had stock options as a portion of compensation packages for usually higher level
Hmm.
managers or something along that line when it came to the seniority of employees. And in 2004, there was some legislation that basically highlighted how does stock options get reported on balance sheets
Yeah.
to public companies. And so when you now have to put in this kind of liability, this expense that shows up there of, hey, eventually somebody's going to basically buy these shares and we're going to have to pay the difference out, that previously wasn't being fully reported.
Hmm.
And so as with most things, once legislation changes something, companies adapt.
Yeah.
And so what we've seen since 2004 is this giant decline from 100% of companies down to about 30 to 40% at the end of
Massive
2024
shift.
having stock options. And these full value awards, RSUs and PSUs, full value meaning once you get access to it, the full share price
Hmm.
is yours. You don't have to buy something separately. Went from around 30% of companies back in 2000, 2003 to 99% of public companies today have some form of either RSUs or PSUs as a portion of it. And so we saw this dramatic cross over the last 20 years. And so most individuals, if you're seeing equity compensation, you're getting access to RSUs or PSUs.
Yeah. The other thing, this just kind of popped into my head here, Aaron, um, on this shift and maybe why this occurred is with stock options, you can also run into cash flow problems
That's true.
where on the other end, if the option has grown a whole bunch and it's done very, very well,
Yep.
you have to pay that difference between the strike price. You have to execute the option. You have to pay for it.
100%, 100%.
And if your lifestyle and your living is based on your salary and bonus and you don't have a whole lot of excess,
Yeah,
you have this nice benefit, you have all this money sitting here, but how do you access it?
that's a great point. And we'll get into this next month in a
Yeah.
bit more detail on in the fact that oftentimes you would see two different types of these stock options that
Hmm.
exist. This is one that you could get access to the cash pretty quickly and utilize that to exercise the other one. But you're 100% right. If the stock price continued to do well, sometimes that could be, even if you exercise one of those options, it wasn't enough to exercise
Yeah.
the secondary and get that cash. Whereas, as we'll kind of chat with the RSUs, once you get it, it's just yours. And so you can turn around and sell it if you want
Yep.
access to the cash or if you still want to stay exposed to the company overall. So we've highlighted a number of different terms in terms of kind of this large shift overall. One thing we want to quickly just unpack real fast is let's define a lot of the
Yeah.
terms that we're kind of going through is let's go through that because as we start to expand upon and explain all these different components, what are people going to hear today and making sure that we're tracking on those items.
Yeah, we should have put this up a little bit earlier. But like to us, we say these terms and we know what they mean, but to most people, this is a foreign language, right?
Yeah.
So grant date, all grant date means is the date in which the award, whether it's RSUs, ISOs, whatever it is, was given,
Got it.
right?
Got it. Yep.
So typically it aligns nicely with a pay stub date or a regular pay date. And whenever the company decides that to pay you that, it flows through your pay stub and that's your grant date. Vesting date, we mentioned this earlier. This is the date at which the award is actually yours and it
Okay.
becomes
Okay.
a taxable event.
So
Um,
these are two definitely different dates that occur.
two different things. Yeah. Grant date obviously is going to happen much earlier than vesting date.
Okay. Okay.
Yep. Exercise date. This is specifically for options. So next webinar,
Yep.
but as you know, we kind of alluded to earlier, this is the date in which you decide to actually go through with the contract or not. And so do I want to pay for this option and execute it or not? That would be the exercise date.
Got it. Got it.
Fair market value is just it's the value, it's the share price at when the tax event occurs. So for RSUs and PSUs, what we're talking about today, that's your vesting date.
Got it. Okay. Okay.
Cliff and graded, this is talking about vesting again. A cliff basically means you get nothing for the first however many years, and then it all happens at the last year. You kind of fall off this cliff, right?
Got it. Got it.
Graded means you get a percentage each and every year over time until it equals 100%. So most times we'll see like a 4 or 5 year graded
Agreed. Yep.
schedule, and it's just 20 or 25% each year. Um,
Makes sense.
Supplemental rate. This refers to tax withholding. Again, from your pay stub is what this is talking about. And this doesn't just apply to equity comp. This applies to bonuses, really any additional supplemental pay you might receive. Most people don't know this, but that's held at a flat federal 22% for most people, unless you're very highly compensated. But
Yeah, yeah. So for somebody who's in, a 32, a 35, or 37% tax bracket, you can be severely underwithheld,
mhm.
especially in the case here. And we'll kind of talk through the tax bomb that can sometimes hit.
Yeah. And I see this sometimes reversing that too, as well as where you might have someone in the 10 or 12% and they get a nice big bonus and that's withheld at
At 20%.
22%. And they're like, why? It feels like my bonus, it feels like I pay so much extra tax on my bonus.
Yep.
Why is that? Well, you're not really paying it, it's withholding, but bonuses are withheld at a flat 22%.
Yeah, and to your point, it's a mandated federal
Yeah.
right that companies have to withhold unless you can elect otherwise. So sometimes payroll will allow you to kind of adjust your withholding
Mhm.
if they've got anything kind of special there. But typically, it's the default rate is kind of a federal mandate on
Yeah.
there. And I think most of that, to your point, since most individuals are probably in the 22 or lower
Mhm.
percent tax brackets, if we over withhold on that, we're not going to have the majority of Americans have an issue where you
Yeah.
get a surprise tax bill. But if you are pushing into the 30s, 32, 35, or 37% marginal tax brackets, this could be a pretty big surprise.
Hmm.
So we kind of talked through a little bit of these schedules. What's the timeline of when you have RSUs kind of pay out from those different dates that you had mentioned earlier?
Yeah, so we kind of name this the life cycle. Basically, timeline. What does it actually look like if you receive an RSU or a PSU? those full value awards. One, it's the grant date. Again, just the date in which it was awarded to you. Then it's going to vest typically over 4 or 5 years.
Yeah.
Now you receive that full benefit. That is your value. You own it. That's tax. That is a tax trigger to the government, to the IRS. Now that you own it and you receive the full value, it's ordinary income.
Okay. Okay.
Then the shares are going to hit your brokerage account. Oftentimes, it's it's weird how logistically they structure it, but oftentimes it's on the same website, but it's in two different accounts. You have this
Yeah.
equity account that kind of just shows you the vesting schedule and holds these future awards. As soon as they vest and they're awarded, they are now delivered to you and they are sent to a separate brokerage account.
Yeah, I know Fidelity.
Yeah.
They're one of the largest providers in the space, and so from a tracking perspective, your 401k and your brokerage account that has everything is on
Mhm.
one website, and then Net Benefits is like this
Yeah.
extra site that has all the details around your equity
Yep.
compensation.
And so then once that is delivered inside that brokerage account, that is now the fair market value. That sets the cost basis going forward on whether it's a capital gain, capital loss, is
Okay.
it short term or long term? And we'll get into that a little bit later. But once that hits that brokerage account, that sets your cost basis. And then ultimately, you own the shares. You get to decide when and how to sell.
Okay. Okay. So to your point, if it's vested and it's delivered to me and the share price is $100 a share, I receive value at that
Yeah.
point in time. So I'm reporting that income. That's what's called having constructive receipt from an accounting
Mhm.
terminology perspective. Is I now have access to the shares. I can choose to sell it or not. That's compensation to me. The IRS views if you have access to it and you can turn it into capital, it is now shares, or it is compensation to you. So I have the value if it's $100 a share, and if between the time that I hold it and I go to sell it, it's gone from 100 to 125.
Yeah.
That is capital gain to me,
Mhm.
which is a better tax rate than my ordinary income that my salary and bonus and these RSUs being delivered and end up being. But that cost basis on the date that it gets delivered to me, that's what's important from a
Yeah.
tracking perspective. And it should be recorded on your software where everything is granted to you, wherever the record
Yeah.
keeper is, should have that detail for you.
Yeah, and I would say that is to double check that because I have seen with a few clients where um for some reason the brokerage account 1099 doesn't list the cost basis.
Oh, that's interesting.
Yeah.
Okay.
And
Yeah.
so if your accountant or yourself aren't aware that there should be cost basis, your whole lot is going to be all capital gains. And
Yeah.
that could be a costly mistake.
Oh, absolutely. Yeah. If I now have to going back to that previous example, I received something at $100 a share,
Yeah.
and if they view it as no cost basis and I sold it at 125, now 125 or
Mhm.
125 is gains, which on $125 might not seem a lot, but think if you got 1,000 shares at that same price point, that's a lot of
Yeah.
income that should have been reported, and you already paid taxes on the 100.
Mhm.
And so that's a good point to kind of double check that. And so having good records is important, and it's part of the reason that we think it's important for clients to keep us informed when you're working with
100%.
a market street advisor of what other kind of compensation do you have? When does this occur? Can you get us schedules of when you're supposed to receive this income? Because it's really impactful from the tax planning that we end up doing
Yep.
for our clients. So let's kind of take a deeper dive into the crux of kind of today's discussion overall is this idea between RSUs and PSUs. These are by far the most common forms of equity compensation that you're going to see. And we highlighted this idea of them being full value. And so the idea behind this is just at that delivery time frame, the full share price is yours. You can choose to hold on to the company stock
Mhm.
yourself, or you can choose to basically sell it and report that gain or loss that occurred from the time that it was delivered to you. And so let's kind of unpack a little bit further about some of the details that's behind that. So RSUs first, I'll kind of unpack this. The idea between RSUs and PSUs have a performance component to it. RSUs, it's restricted. So restricted stock units. The units are like a proxy for the actual shares themselves. You're not holding the shares in the months or the years between grant and vest
Okay.
of receiving those. They're basically just a proxy for those. But what ends up happening is and you'll have an agreement for basically every single one of these that gets granted.
Yeah.
Sometimes it can be a daunting amount of paperwork if you receive one or two or five different RSU
Yeah.
grants every single year. You'll get basically an agreement on this is exactly how that document is going to kind of operate for that particular grant. But the units themselves, it's a promise that your employer has basically said these units are going to convert to shares after that vesting date. And so they make you this promise that the future date, your vesting date, you're going to receive the shares. But most often, to your point from earlier, to align from a retention
Yeah.
perspective, it's hey, you have to have worked up through that vesting date. Occasionally, you will see the ability for these to vest even if you retire, or sometimes there's triggering events that do allow. Like if you were to tragically pass away
Yeah.
and you had outstanding RSUs, some employers will have a clause in there that if it was an unvested RSU, that would still be left to your surviving spouse or your
Sure.
heirs at that point in time, because that can feel pretty penalizing where you've got a lot of compensation tied. You theoretically earned it, but you didn't earn out the rest of your time frame. But in most cases, the idea is you have to work through the eventual vest date or the calendar year prior to that vest date
Yeah.
itself to have those delivered to you at that point in time. So at grant, that grant date that you had kind of highlighted, no shares are actually delivered to you. You basically are just given kind of a contract, this
Mhm.
promise that they're going to have. You have no voting rights. They're not actual shares to you. 83B, we'll talk about this a little bit later, but since you don't have access to the shares, you can't change how the taxable income is being
Okay.
reported to you. And so to that point, it's not a taxable event. So different types of compensation, sometimes when they get given to you, granted to you, there might be a tax component to it. This is not one of those situations. And so it's just purely a promise. Where the dollars end up impacting you from a tax perspective is on delivery, that vesting date.
Yep.
When that happens, the shares that were promised to you get delivered to you. The share price on that day, the fair market value, is ordinary income. It's just like if you received that compensation as salary.
Yeah.
It's just an additional salary or a bonus. And then now you own actual shares in the company. So if I wanted to vote for what I think the strategic direction of the company is, I have voting rights based on each of those individual shares.
Hmm.
And then going back to your component, now that I've reported that income, I have constructive receipt. It's income to me. I now have a cost basis. And what ends up happening from that point forward will be long-term or short-term capital gains or
Yeah.
losses, depending on what ends up happening from a stock price perspective. But what we kind of highlight here, there's no purchase required. These are just automatically deposited into that brokerage account for you. And the voting rights in the 83B elections, not something that you have access to during that vesting period while you're waiting to get access to the shares.
Yeah. The best way I've found to think about RSUs is to think about it just like a cash bonus that is given to you over time versus all at
Yep.
once.
Yep. Yeah, to your point, and let's kind of talk through that and how
Yep.
that can be structured. We've already kind of roughly alluded to it, but we've got a couple examples here of like what ends up happening in this case when it comes to there's really three main components. The third one's not as common, that's more with PSUs that are
Yeah.
happening, but what are the main things that trigger that actual receipt of the shares
Yeah.
themselves?
So the two most common types of vesting schedules, which we've already mentioned, is your cliff. So I think that graph, that visual explains it perfectly. You get nothing
Yep.
through the first 3 years. Year four, you get the whole amount. So let's say your RSU is valued at $10,000. Years 1 through 3, you get no value.
Yep.
None of the
Yep.
10,000 are you receiving. Year four, you get all 10,000. That is reported on your pay stub. It's reported on your W-2. It acts exactly like a cash bonus, so it runs through ordinary income.
Yep.
The 10, the 12, the 22, the 24, and so on. Um, I find that I don't see that too often with clients. More so, I see the graded basically over time, because this is how companies can kind of get you with those golden handcuffs.
Yeah.
It's you receive a portion. So in this example, it's 4 years. You get 25% over 4 years. And how they kind of get you with this golden handcuff is most often you get an RSU grant each and every year.
That's right. That's right.
So year one, you're gonna get 10,000 and you're gonna get 25% of that. Year two, you're gonna get another 10,000, and now you're gonna
Yep.
get 25% of your year one and 25% of your year two, the two
Yep.
different
You're up.
grants, right? And so then they just start stacking on top of each other.
Yeah, I often, we were kind of chatting before the
Yeah.
webinar of how I generally kind of view this is a lot of times it becomes a bigger concentration point of
Hmm.
your overall compensation is the first year or two that you end up getting RSUs granted to you, it's great. It's this additional bonus.
Yeah.
Once you've been at the company for a while and you've been getting RSUs every single year, you might end up with 1 year where you get a portion or a small portion of that first year's RSUs, but you might also have 3 years
Right.
prior worth of RSU grants that are all hitting at the exact same time. And it becomes this larger chain, if you will. It's
Hmm.
kind of chaining you to the company. Year one, small component. Year two, slightly larger. Three, even bigger
Yeah.
still. Four, it's a massive portion of your overall compensation because you're receiving a vesting, if it's one of these graded schedules, that's all hitting at one point in time. And what I've often seen is companies end up changing these schedules so that they don't have to stick to the old schedule that they end up
Yeah.
using.
That's
I've
true.
got some clients that they've got a mix of some of these cliffs that end up hitting at one point in time, and they've got one where it's a third, a third, a third,
Okay.
and then they switch to 25% every year. Or I've seen some where it's you might get 12 and a half in year
Yeah.
one, you might end up getting 25 in year two, and the percentages can be kind of wonky. And so this is again, we love looking at the puzzle and kind
Yeah.
of figuring out how does that tie to it. So if you've got scenarios like this for your own compensation, we want to be able to kind of help paint that picture of
A
how
hun-
significant is that compensation to you.
100%. And it's not just from a, yes, from a tax perspective. It's okay. This year it's a little bit less. Next year it's a little bit more. Should we
Yep.
defer income in the higher year? Should we maybe do a Roth conversion in the lower year? Basically, yes, there's a tax component to this, and we can help plan with that. It's
Yeah.
also like some life and goal decisions too, right?
That's very true. Very true.
If you want to take your family on a bigger, nicer vacation from a cash flow perspective, it might be nice to line that up with a big vesting of an RSU. So
Yeah.
it's both tax and the life financial planning side of it as well.
Yeah, yeah. So that's a good point. The last thing that we didn't really cover too much in detail on here is like this idea behind performance based ones. We'll cover this here in a moment on kind of
Yeah.
PSUs. Most RSUs operate on one of those schedules where it's just after a certain period of time you get granted to them. There are sometimes additional conditions, and sometimes you've seen what's called like double trigger RSU events that occur where you have to meet the vesting schedule itself. But then there's also a performance component where if the company hasn't hit a certain earnings per share target,
Hmm.
you don't get the shares. But if they have hit it and you've hit the time weighted component, you get the full value of them themselves. And then PSUs, we kind of highlighted on here. What'll end up happening is sometimes could get zero, could get 100% of what's laid out in the contract. But if there's a stretch goal that gets hit, you could even double the amount of shares that you
Yeah.
get, which can be really nice to your point. Single year balloon in income. And if you're using that for any kind of larger trips, vehicle
Yeah.
purchases, sometimes I've seen down payments on second homes occur at that point in time when you see some large jumps in income overall. So from a tax treatment perspective, how are these taxed? We've mentioned ordinary income.
Yeah.
That's really only at the federal level. What's the
Yeah.
other tax components that we're going to really deal with when it comes to receiving these?
Yeah. All right. So tax class here. As we said, this acts just like ordinary income. So not only is that going to affect federal rates, it's going to affect state here in Indiana, it's going to affect local income tax.
Yep.
You're going to have Social Security, Medicare. Um, so, if you're in the 24%, state and local, maybe add another five or six. You're
Yep.
already at 30% tax there. Social Security is at 6.2. There is a wage limit, meaning if you make more money than a certain threshold, that Social Security tax kind of drops off.
Yep.
Um, so you may be over that, you may not. And then Medicare is an additional 1.5, again with a threshold, but in the opposite direction. If you're over this threshold, it doesn't drop off, it actually increases.
Yeah, you had the 0.9%
Yeah.
Medicare tax. That's right.
So this can be a pretty big tax event, and it's something to think about. It's something to plan for. And then, as we mentioned earlier, once that hits your brokerage account, it vests. It's in the brokerage account. Now you have your cost basis, and then going forward, it's whether or not you want to sell it, and that becomes capital gain.
So I can receive all of these shares, but I don't necessarily have to sell them, right? However, I still owe taxes on them.
100%.
So how do we handle the taxes when that occurs themselves? Let's kind of unpack
Yeah.
that as another piece of like, there's options in terms of doing it if But if I receive $100,000 worth of RSUs being received into my brokerage account, but I've not sold any of them, I still owe the taxes.
Yeah.
And to your point, if it's 24% marginal bracket plus another 5 for state plus Social Security and Medicare that's existing, I'm really pushing closer to 40% in taxes that are owed, maybe even higher if I'm in a higher marginal tax bracket. What are my options to cover that tax bill?
Yeah. So the vast, vast majority of the time, it's going to be that first one there, that sell to cover, right? Basically, the brokerage account, the custodian is going to sell and withhold 22%,
Okay.
right? That if you're in the higher brackets, that's not going to cover it all, I think is what you're kind of alluding to.
Yep. Yep.
The other option is you don't have anything withheld and you yourself make like a quarterly payment. The
Okay.
the idea there is you are wanting to you maybe are very bullish or very optimistic on the company stock and you want to own and hold as much stock as possible, so you don't want to sell and use the shares to pay the taxes. You just want to own all the shares yourself, so you don't have anything withheld, nothing gets sold, and you hold all of those shares.
That makes sense. So from an alignment perspective, going back to kind of one of our first slides, if I really am bullish on what the stock price is going to do,
Yeah.
you have to sell them to pay the tax bill.
Right.
But the tax bill is still owed.
Yep.
And so I have to pay it outright. Okay.
And then do you want to cover the next two, net share settlement? I'm not super as familiar with that one there, Aaron.
Yeah, yeah. So the individual component with a net share settlement is you still retain the shares themselves at vest, you cover the taxes themselves, but there's not an actual sale that occurs. So sometimes what ends up happening is instead of, let's say I had 1,000 shares that were going to be granted to me,
Mm-hmm.
but I needed 220. Let's go back to that 22% side of it that needed to cover my federal tax component. Instead of actually being delivered as 1,000 shares, they're only going to deliver 780 into my brokerage account. Whereas the sell to cover, the full 1,000 comes in and hits my account,
Yeah.
but I sell them right away
Yeah.
to cover that itself. It depends on the instructions. A lot of times, net share settlement and sell to cover often are basically about the same.
Okay.
You're still reporting the income regardless. It's just what ends up happening is the shares get sold even prior to them actually depositing them into your brokerage account overall.
Interesting.
We don't see net share settlement very often overall. And then the sell all, this is one of those situations where you just say, hey, once I get access to the 1,000 shares in that case, I want to sell the entire amount.
Yeah.
And I will have all of the cash, and I can now have some withholding that occurs. Oftentimes, the 22 gets withheld off the top, and then the rest is cash that I can choose to invest into other funds, other stocks, transfer to a different brokerage account or to my bank account if I was going to use it for any other reason. And so this is what, when you kind of really align with, I've got enough compensation and stock exposure to the company that I work for, I want to diversify out of this kind of
Got it.
overall. So what we most often see, to your point, is sell to cover. Let's sell a portion of the shares to cover the tax withholding piece. Or if I'm, to your point, really want to be bullish on the stock and kind of hold on to it, I'll pay it through excess cash somewhere else, or selling all of it if you're in the spot of, I've got enough exposure to my company stock from a diversification perspective. I just want to sell all of this because it's going to be taxable income when it hits.
Yeah.
I don't want to wait and see what the stock price is going to do in the future overall. The biggest surprise that we've often kind of highlighted is the withholding gap problem. So we talked about that supplemental rate, this kind of statutory 22% withholding. That can be really shocking though, where if I'm in a higher tax bracket, and mind you, the RSUs being vested, that's more income that's pushing up my overall tax bracket itself. We can have this gap occur. So what ends up being the biggest surprise there, and how can we kind of offset that?
Yeah. So this tax surprise, I like to call it, almost like a tax bomb at the end of the year, right?
Yeah.
So what happens logistically is that flat 22% is going to be withheld from your RSUs.
Yep.
There's a good chance that you're a highly compensated employee, you're in the 32, 35, or 37. In this example, we're using 35%.
Right.
So that 13% delta, that's going to be due in April. or whenever you file your
Okay.
tax
Okay.
return,
Yeah.
right? So if we're talking $100,000 of RSUs, 13% can be pretty healthy.
That's an additional $13,000 tax bill, and we kind of created an example here to kind of
Yeah.
unpack that. So putting some numbers behind it, we've used what if I got 1,000 RSUs that were granted to me a few years ago, and in this case, we're going to use a full cliff
Sure.
scenario. So it's been 3 years, that cliff has expired, so I've received all of the shares today, and it's $100 a share. So my total value, the RSUs that vested plus the market value of $100 is $100,000 of compensation. If my employer is only reporting and pulling out, withholding at that supplemental 22% rate, it's only going to withhold $22,000 worth of taxes. But if I'm in the 35% marginal tax bracket on that 100,000, I really should have paid 35.
Hmm.
So come April, I owe 13,000. And what we very often see is a lot of times the vest dates for these RSUs are early in the year.
Yeah.
And so if I owe $13,000 on 100,000 of extra income in January, February, my tax bill might not be due until the following year,
Yeah.
but the IRS doesn't view income that way.
No.
They view income as you earn it throughout the quarter. And so if I'm waiting to pay that 13,000 the following calendar year, there can be some under withholding penalties, and those are charged on a monthly basis based on when that income occurs. And so you end up having to pay a pretty decent penalty
Yeah.
in association. And that goes back to your point of I either want to potentially, if I can, increase the withholdings on the
Yeah.
RSUs
Quarterly tax
or pay
payments.
quarterly tax payment itself.
And this can compound. Like this same 22% supplemental rate applies to bonuses as well.
Oh, that's very
And
true.
so oftentimes these highly compensated employees don't, not necessarily just have RSUs, they also get cash bonuses.
That's true.
So if
Yep.
you get $100,000 of RSUs and you're 13 grand short, you get a $100,000 cash bonus, you're another $13,000 short. So this can be a pretty big surprise for people at the end of the year.
That's a good point. It's always nice to have that bonus that hits.
Yeah.
But proper tax planning is understanding what's that bill going to look like
Yeah.
and making sure that we're kind of prepared so it's not
100%.
such a large surprise. Unpacking the second type that we often see is not as common as RSUs. I think going back to that study that we kind of referenced earlier, you see RSUs typically are around 99% of companies itself. We're closer to in like the 40 to 60% range that actually have performance awards. But think of this very similar to how the RSUs operate. They typically have a grant date with a vesting schedule, but they're tied very specifically to a performance metric. And so you'll receive them, but it's only if there's certain targets that get hit at that time. That's the performance side of this compensation. It's very much like an RSU, but it's got this hurdle of the company has to hit a certain target overall. If you miss the target, you could receive zero.
Yeah.
And so I've seen that happen where unfortunately companies were close, but you end up with no shares actually get delivered at the vesting date. If you end up hitting the target, you receive the full value. So these are oftentimes presented as kind of an additional bonus, but it's with the caveat of it very well could be nothing.
Sure.
But the intention behind it is, hey, if you do your job and everybody does their job and we actually stretch beyond that and we hit a second goal, you're seeing oftentimes 150% of the target or 200% where, hey, the 1,000 units that I said earlier
Yeah.
could be 2,000 units. And now my income had a significant jump. And while the taxes go up, taxes are always a sign of something good happened.
Yeah.
And so if these performance awards happen and I double the amount of performance awards itself, I've got double the amount of that income. That 100,000 becomes 200,000. That's a fantastic year overall.
Mm-hmm.
And so that's the idea behind performance awards. Is you're marrying up the time-based piece, but you're adding in some more incentive for this performance metrics. And what I've seen a lot of times is you'll start as an employee as you kind of work your way up through kind of the corporate ladder, if you will. RSUs will be kind of your first intro into equity
100%.
comp. Once you get a couple rungs above that, performance awards become a component because
Yeah.
you now drive a lot more performance of the company as a whole. The tax components, and this is kind of a similar slide to what we had covered earlier with the RSUs. It's very much the same. It's just the difference of when that performance metric actually hits, what's the tax rate going to be, but you're still subject to federal taxes, still subject to state and local if possible. Oftentimes, if you're getting performance awards, your Social Security's already been
Yeah.
covered at that point in time. You're beyond the wage base there, but the Medicare will kick in. You'll still have the Medicare taxes themselves. Once you receive the value of the shares, just like RSUs, that sets your cost basis. So what ends up happening to the stock price from there impacts your overall income in the future, whether or not it's capital gains or losses after that. The difference is just it could be zero, it could be 100, or it can be 200% oftentimes. And so when we're kind of doing planning from that end, a lot of times we'll take the target approach of, hey, we think we'll hit the target,
Sure.
or it could be zero. But if it ends up being larger, now we've got a surprise amount of income. We really need to review the tax situation
Yeah.
to make sure that we're not getting totally shocked on that end. And so it's one of those things where oftentimes doubling it and hitting the stretch goal, that's gravy on top, in my opinion. It is just it's a nice boon to have happen, but it's not something that we're kind of expecting on a consistent year-over-year metric. The last one of these kind of awards that we wanted to cover is restricted stock awards. So they're a little bit different. These were used a lot earlier, closer to that stock option years that we kind of highlighted earlier in the early 2000s. So what ends up happening in this case is you actually have what's called constructive receipt as the recipient when these are granted to you. You're actually given the shares, whereas the RSU has this contract that says you'll get access to these shares at a future vesting date. Our restricted stock awards, you're actually given the shares right now. And so because that occurs, there's a difference from a tax perspective on those overall shares themselves. You can still choose to basically wait and treat them like an RSU. Once the vesting occurs, now I have income that gets reported at that point in time. But because you get access to the shares sooner, you can make what's called a Section 83B election. And so an 83B election is what can be really, really powerful if you're still expecting the stock price to go up.
Okay.
So let's kind of unpack this from a perspective of typically the IRS, they view once you have access to the funds, it's taxable income to you. So let's say you get 1,000 shares, but the stock price is $10 a share. And we're expecting that after vesting, it's going to be 100. It's going to go up 10x at that point in time. Huge increase. Well, with the 1,000 shares at $10 a share, okay, I've got $10,000 of income that I could report now, knowing it's going to be 100,000 in the future. If it's an RSU, I wait and I report $100,000 of income after vesting. But an 83B election allows me to say, I want to report this income in 2026 when that's granted to me. And so I'm going to pay taxes on the $10,000 of income now. I'll pay my ordinary income tax, my state and local, my FICA, and everything. But I've set my cost basis.
Right.
Because I have actually reported that income and I've paid the taxes on it. And so I've set my cost basis now. So now if it goes up from 10 to 100 in the future, that's all long-term capital gains. So instead of the 22 and the 32 and the 35, we're looking at, in some cases, zero, probably not in this case, but 15% for capital gains. So the difference between the 22% marginal bracket and 15, or the 35% and the 20, that's 15% difference in taxes. And so I have this incentive to say I want to report the income and pay the taxes now, which could turn out to be the wrong call. But if you're really bullish on what the stock's going to do, very much can be a really nice tax benefit overall.
Yeah.
The downside is you still have the vesting piece. So kind of highlighting here is like what ends up happening is I think the upside is known. It's easily understandable where, you know, if I report the income earlier and it goes up a lot, I pay it at a much lower tax rate. Downside is it still has to vest. So I could report the income, and if I leave and I don't vest those shares, I paid taxes on something that I don't have access
to. And you never received the actual benefit.
Exactly. And so there is a dichotomy that you kind of have to navigate with the 83B. You've got to have this conviction that, hey, I'm still going to be here when that vesting schedule hits. The other thing that's kind of tricky because it is a nuanced tax election is you have to file that within 30 days of being granted. So it's a decision.
It's a short time window that you have to make that decision.
Yes, you have to make that, and you have to be convinced that, hey, I'm going to stay here and I'm going to receive these awards in the future. And so it is definitely a shorter time decision to occur at that point. Okay, so we're gonna kind of quickly touch through some tax planning considerations. We walk through most of the
Yeah.
navigation of all of these themselves, but just really quickly, when I sell the stock or when I receive it, we talked about that cost basis. What's the difference between if I sell it within the first 12 months after I receive that shares, and let's say it's gone from $100 to 150 a share in a 6 month time frame, and I sell it at that point in time?
Yeah. So in this example, RSUs have vested or PSUs have vested.
Yep.
They're in your brokerage account. You have the shares.
Right.
The stock goes up. They've appreciated. You've earned more money, and you sell within 6 months or basically before 12 months. That difference between, let's say, $100 a share to 130,
Yep.
that $30 difference is going to be considered a short-term capital gain.
Okay. And how's that taxed?
So that's going to be taxed at your marginal ordinary income rate. Um, so again, for most people in this situation, at least 24, 32, 35, maybe 37%.
Yep.
If you hold it for more than 12 months, that's when the long-term capital gains. So that $30 difference, most likely taxed at 15%, possibly 20%.
Okay.
And so, I mean, I think the consideration here, things to think about if we were talking about this with a client is, how do you feel about the company stock?
Yep.
How much is your current net worth? How much do you already own?
Yep.
I think I like to frame it as if you were to get $100,000 in a cash bonus, would you go buy $100,000 worth of your company stock?
Oh, that's a good perspective. I
Hmm.
like thinking about that because you could, yeah, sell it right away,
You can, that, yes,
and you'd be in no different of a tax situation overall.
you're exactly right. I think where people maybe get tripped up is they don't make a decision or they don't have a plan. So
Got it.
if you're going to do short term, it's almost you almost want to do it sooner rather than later.
Yeah,
So
I can.
as soon as those shares hit your brokerage account and they're there and they're vested, you can sell that same day and you can move to cash.
That's fair.
And as long as the price hasn't moved that much because it's the same day,
Yeah,
you're most likely not going to have any capital gain at all.
and what I will add as a nuanced component to
Yeah,
that is sometimes these vesting dates are before like a reporting window where the
sure.
company's going to report
100%.
earnings, and so it can work either way.
Yeah.
And so what's kind of funny is a lot of times if you don't know you received all of these shares and you don't know what the earnings are necessarily going to look like, it could work to your negative where you lose
100%.
value in those shares you hold on to. But at the same time, it could be something where if it's going to have a decent bump or you're expecting a decent bump, selling it at short term, that's I would say that's the asterisks that I often have to look for
Yeah.
on that decision.
Or you don't want to get in a situation where you're in month 10 or 11 and you
You want
decide
to
to
sell.
sell.
Yeah.
And it's like you could have waited 20 more days, 30 more days, and it would have been long term, right? I
Yeah.
think the point here is one, to understand how it's taxed once it actually hits your brokerage account, and then two, just to have a plan for it.
Yeah. Which I think, to your point, highlights really kind of what our next piece is of just this idea of it becomes a larger portion of your overall net worth. And we think that just having a plan for what you're going to do is important because we really have multiple points of exposure
100%.
now to our employer. If I'm receiving stock, in addition to I have salary, in addition to your point, I've got bonuses often. There's
Hmm.
three different types of income that I receive from here. Plus, more often than not, I have my company 401k is still somewhat tied to my employer. They're putting dollars into it. I've got health insurance
Yeah.
that's tied to them more often than not. So it becomes a much larger concentration component. And so what do we typically tend to look at when it comes to as that becomes a bigger component? When should we think about diversifying it?
Yeah, and I think before we get there, I think what we're talking about here is concentration risk, right? Just to define that, it is saying you have a lot of risk tied to one company. So if you were to see the stock go down in value, if you were to possibly be let go, if some negative event were to occur, your net worth, a lot of it is exposed, you holding a lot of company stock, it could take a big hit. Things could change very quickly.
Yep. Yep.
Again, so the point here is just to have a plan. I like to use the rule of thumb, when we're talking about a single company stock, I like to start the discussion of diversifying, basically selling out, having that conversation around 10%.
That makes sense. Yep.
Once we start to reach beyond 15 or 20%, I'm maybe knocking on your door saying, "Hey, we need to do something here."
Yeah, yeah, I think that's fair. Around 10% into a single stock exposure, we start to get some concern of
Yeah,
we should at least have the conversation, start to build that plan of how are we going to unwind some of this. It becomes a larger portion of that. Now, a big portion of your net worth can start to really swing based on what
100%.
happens with one company, and we often view diversified investing. It's difficult to beat the overall market when you've got a ton of companies that are appreciating over time. But in any given year, one company can really have a really poor year and
Yeah,
have a drag down in overall performance. And that can really kind of impact not only net worth, but now it starts to impact your retirement. If you're a handful of years out of retirement, you've got so much exposure to one company and that kind of goes down. Now you might be looking at, do I need to work an extra year or two in
yeah.
order to make this actually kind of beneficial? All right. Well, we went a tad long, covered a lot of ground today, and kind of covering the RSUs, PSUs, and restricted stock awards. Real quick, kind of sneak peek at next month. We will chat about the two main stock options that exist in the world are non-qualified stock options and then ISOs. These ISOs are a little bit trickier when it comes to some tax
There's
implications.
gonna be some meat there.
Yeah, there's a little bit more technical math. We'll try to keep it as conversational
Yeah.
as we possibly can during that time frame. That'll be sometime in May. We'll nail down and get everybody an idea of when that's going to occur and what the timeline is. As always, thank you for joining us for one of our events. Thanks for joining me behind the desk here
Yeah,
on the
absolutely.
webinar itself. If you have questions, reach out to your Market Street advisor. We're happy to kind of unpack this. If you've got equity compensation or if you've got a friend that has it and they're really asking you, they don't want to know, our educational approach. We want to lead with education, make sure that you fully understand how it applies to your situation, and we're happy to always have that conversation. So thanks for joining me. Thanks everyone for being a part of this, and we'll talk to you soon. Have a fantastic rest of your week.